your first target price is going to be somewhere here, right? So when you think about 3 contracts and you work out the numbers, very simple. If you're a buyer of, say, 70 and you take some money up here, say at 20, that's going to be a $500 profit. So there's your first 500s. You then come up into the next level here about 60. So what is the profit on that one? It's going to be about $900. Okay, so you get about $900, and then you've got the third contract, which obviously runs to your full target, which is 77 evens, and you're making, say, $1,400. Well, you can see the difference now on that trade as far as a world-class top-line professional could do potentially in 3 contracts. $2,800. So it's nearly 2 times the size of the spread, nearly 2 times the size of the move on a 3 lot. Now that would be world class. That would be real top of the class, world class. You know, that's the 1% of the 1%, that type of performance. But if you can get to close to those kind of numbers, I mean, so for example, if you took your first trade out for plus 10 contract for first 10 ticks, and you took that one, and then you took your second trade out for $500, and then you let the second trade, the final trade, run to the full target of 1,400. Now that looks more realistic. You're still making in excess of, you know, well, you can see $2,000 on a $1,400 swing. That's plus 1R on that whole move. That's a big plus one. Big plus one, because you're making around about 2,000 on a $1,400 swing. Now that's you way above that ratio, way above the ratio, if that's what you're doing. But if that's what you're doing, and you're on 3 contracts and you make 2,000, well, that's the equivalent of $650 a contract, really. So, I mean, when you look at that $650, if that's right on point for a world-class trader, right on point for a world-class trader, you should be looking at that and going, oh my God, that's crazy money. Crazy money. But you should get less nervous when you get profits, Scott. Less nervous. You should get the most worry you should have is when you're getting into your entry price, because that's when you're getting challenged. When you're getting away from the challenge, now it's just a case of try and hold on to it for as long as you possibly can, and be willing to give back some money. You know, and you only give back money, remember, if you are ending up on a trade that the value changes on. If the value stays with you, you stay with the deal. You let it roll backwards, you let it roll forwards. And how do you solve that problem? You have the ability to buy back in if you do take profits. So if you buy 3 contracts here and you take 1 out here, you buy back in another contract here, you take 1 out here, you buy 1 back in here, you take 1 out here, you buy 1 back in here, you take 1 out here. And you could end up running the 3 contracts for almost the entire move. It's the ability to buy back in if you've exited. If you see the value becoming incredibly bullish and you start regretting the fact that you exited with a big profit, then it just means you can come straight back in again and just take some more business done. You know, so a lot of that fear, a lot of that worry that you're going to give back money can be solved by simply getting more active in your open trades. So taking profits, adding back in, taking profits, adding back in, taking profits, adding back in, taking profits and adding back in would have meant that you could have ran the entire move from start to finish. So it's just something to practice on, but I wouldn't be unhappy with a $600 swing out of a $1,400 move. I think that is absolutely superb performance.